Investing in index funds is one of the easiest and most effective ways to grow your wealth over time. One of the most significant benefits of index funds is their ability to leverage the power of compound interest, which, when combined with consistent, long-term investing, can significantly boost your returns. First, let's go deeper into what makes index funds a great investment. An index fund is designed to mirror the performance of a market index, such as the S&P 500. The S&P 500 index includes 500 of the largest companies in the US, and these companies make up a significant portion of the US stock market's value. By investing in an index fund that tracks the S&P 500, you're automatically investing in the top companies across various sectors. This diversified approach helps you reduce risk compared to investing in individual stocks. Here's the thing, historically, the S&P 500 has returned around 10% per year on average, including dividends, over the long term. Let's say you invested $1,000 in an S&P 500 index fund 30 years ago, and you continued to invest an additional $100 every month. Assuming the average 10% return, that initial $1,000 investment would grow to over $30,000 just from compound growth. If you continued to add $100 a month, your total balance would exceed $200,000. This shows how consistent monthly investing combined with the power of compound interest can yield impressive results over time. Here's how compound interest works in the context of index fund investing. When you invest in an index fund, the money you earn, through capital appreciation and dividends, is reinvested back into the fund. This reinvestment is key because it allows your money to earn interest on the interest, exponentially increasing the potential growth of your investment. Let's break it down with an example. Imagine you start investing $500 per month into an index fund that tracks the S&P 500. Over the next 20 years, with an annual return of 8%, your monthly $500 contribution could grow into around $300,000. In this scenario, nearly $100,000 of your total return would come from the power of compound interest, not your actual contributions. The longer you invest and the higher the returns, the more your money works for you. Now, how do you apply this strategy practically? You don't need to be a stock market expert to invest in index funds. Many platforms, such as Vanguard, Fidelity, and Charles Schwab, allow you to invest in low-cost index funds and set up automatic monthly contributions. This is where compound interest becomes incredibly powerful. With a regular, automated investment schedule, your money works harder, and you don't have to worry about trying to time the market. For example, if you set up automatic monthly contributions to an index fund that tracks the S&P 500, your money is always working, whether the market is up or down. Even during market downturns, your automatic investments buy more shares of the fund at lower prices, which helps your portfolio grow more when the market rebounds. This is why regular contributions are such a crucial element of investing in index funds. They allow you to take advantage of market volatility and increase your holdings. To get started, you can use a compound interest calculator to visualize how your monthly contributions will grow over time. For instance, if you use a calculator and input your initial investment, monthly contributions, expected return rate, and investment timeline, you'll be able to see exactly how compound interest will work in your favor. The longer you invest and the more you contribute, the more you'll see your money grow exponentially. Let's add a historical example to further solidify this strategy. Between 1980 and 2020, the S&P 500's average annual return was about 10.5%. Let's say you invested $100 per month into an index fund that tracks the S&P 500 for 40 years. At that average return, your investment would grow to approximately $500,000. However, if the return had been 7%, which is more conservative, your investment would still grow to nearly $250,000. This historical performance shows how even moderate returns combined with consistent investing can lead to significant long-term growth. In conclusion, Investing in index funds and leveraging the power of compound interest is a strategy that can work for anyone, no matter how much you start with or how old you are. By making consistent, automated monthly contributions and allowing your investments to grow over time, you can take advantage of the exponential growth that compound interest offers. Whether you're saving for retirement, a down payment on a house, or another long-term goal, index funds provide a low-cost, diversified way to invest and build wealth.